Hi everyone, Leah the trader here from TMAT, Trading Mindset and Data. Today I want to talk about why is it important to keep following your trading plan and not micromanage your trades. So when I'm structuring my trades, I always have the entry, stop and the target. And why I'm doing that is because simply I need to know what risk to reward my trades are going to have. So I want to make sure that I'm making more than I'm planning to lose, because you can lose 50% of time. There are some months that I lose 70% of time. Win rate is really not that important. Important is the risk to reward. So a lot of times I get stopped out and new traders will tell me, why did you not get out of the trade earlier? Why did you let it go down? Why did you let it go down to 1 hour loss or to the planned loss when you saw there is a weakness? Or why haven't you taken profits earlier? What have you, there's all these questions because a lot of new traders, they want to micromanage positions. And quite frankly, it doesn't really work because you never know what the market will do. And then you just start having this anxiety and panic, and micromanaging never really works. Plus, you cannot really test if your strategy works if you're constantly micromanaging. So let's see here. All right, this is my plan, and I'm going to structure this trade that it's a 4-hour trade. I might, of course, depending on the market, if we're in a choppy market, I might give it a little bit more stop. I could go down to here on this trade and give it 2.2-hour trade. Right, in a choppy market, 2 hours is really good, but you want to make sure you have this kind of setups, and that's what you're taking, and you're just not making them, oh yeah, let me put this hour here. You have to really look at the supply and demand, where is the potential bounce and where is the potential level. So here in this trade, of course, 200 is an entry breakout of this level, 200 moving average, the gray line, and then we have a stop close to the trend line, which is giving us about, just to compare, about 10% also. It's a lot, right? 10% stop. And then we are targeting the previous levels, and where is a TMAT indicator showing us that there is supply. So when I see that this trade is going to, be choppy and weakened, I'm not going to just freak out, because you never know. You sell and then the stock goes higher and you're going to keep beating yourself up. So Oscar is a perfect example. All right, let's look at this trade. I'm going to remove all this so I don't confuse you. So Oscar, we entered on right here on August 7th. And we entered Oscar at 14.95. We had 14 as a stop. You see it right here. And, we almost got stopped out here, but not that, it wasn't that close. But it was getting there. People were stressed. No, we're going to lose money. Sure, some people probably saw 2 red candles, freaked out and sold. And then look, now they're stressed out. The problem, what happens here is A, you're not following your trading plan, so you don't know if your strategy works, if you're doing a good job. You can't compare, you can't analyze. If you keep doing this, you're going to be cutting yourself short, because you most likely are doing it on the write up as well. Right, so here maybe threat, oh no, I get out, I get out. You can't do that. What you can do is a trailing stop. So like you could here, after this massive pivot, 2 red candles, you could move your stop to 14, let's see, what is it there? 14.29, and now you could move your stop to 14.71, and now 15.72, right? So you're moving them as pivots, which is fine. But you see, we're still in this trade, and I can guarantee you a lot of people did freak out on those dips. So that's just an example, and especially super important for new traders before you actually learn how to read the market, how to read the momentum, how to read, there's a lot of chatter about this name. There's a lot of flow into healthcare. UNH is doing well. Lilly was doing well. I know, NVO, like all those stocks are waking up. So why wouldn't you want to stay in this trade, right? So now we are definitely filling the gap, and we're gonna revisit. But again, if you have a trading plan and you have your stop, just wait. Sometimes, people will say, oh, Leah, you should have gone out. We got stopped out. You shouldn't have stayed in. Like Zeta, for example, Zeta was an ugly one. It was really annoying. Like here, it wouldn't want to like do anything. And then we did get stopped out right here. That was the old trade that we had. And people like, why didn't you get out when you saw this red? I'm like, well, because my stop was here. These are very volatile stocks. Sometimes they will recover, and then what happens? You will be having a FOMO. You will feel bad that you did not stay in this trade, because let's say you had this candle, you freaked out, sold, and not got stopped out at the level where you should have stopped out, which for me was the gap. And then people will enter later, or you don't know what happens. Of course, here we had a huge gap which you never knew. Get into this supply now that I don't want to trade it anymore. But yeah, now it's chopping again at this level because there is too much supply. Point is, you want to have an anxiety-free trading. You want to have a system you can rely on, and you can only do it if you really observe your system, and it's also showing your discipline, which is super important for trading. So do not be worried of the losses. It's okay to get stopped out. If you follow your plan, it's fine, because you will make the money back. Trust me. All right. Join TMAD if you want, guys. For YouTube viewers, we have a discount code U10, YOU10. You have 10% discount on the first month to check it out. TradingmindsetandData.com. You will find us there. Bye.